Yield the floor. Note the absence of a quorum.
The clerk will call the roll.
Mr. Alexander.
Springsteen fan. I know I am. We're close to Jersey. Anyway, thank you, Gabe. Good morning, everyone. Welcome to the second general session. It's an honor and a privilege to be here this morning to begin my MBA executive service during the year of the MBA's 100th anniversary. I'm truly excited to be serving our membership with such a great team of professionals. Now, all of us in the room know too well, 2013 has been a year of regulatory implementation. Many of the new rules we're incorporating into our business operations were a direct result of the 2010 Dodd-Frank Act. Since we are celebrating our 100th anniversary right here in Washington, D.C., the birthplace of the historic change to real estate finance in America, we thought it would be appropriate to hear directly from the policy leaders at the forefront of that change. Their jobs and responsibilities are challenging, protecting consumers and the real estate finance market from the mistakes of the past, but simultaneously creating an environment of economic growth and stability within the marketplace. We applaud them for their inclusiveness they've shown our industry during the regulatory rulemaking process, and our speakers this morning understand the importance of coordination and input from policy leaders, consumer advocates, and industry professionals. And so now it gives me great pleasure to introduce our first honored guest. On August 25, 2009, President Obama designated Ed DeMarco the acting director of the Federal Housing Finance Agency, the regulator for Fannie Mae, Freddie Mac, and the 12 federal home loan banks. Previously, Mr. DeMarco served as FHFA's Chief Operating Officer and Senior Deputy Director for Housing Mission and Goals since FHFA's inception in 2008. A career civil servant, Mr. DeMarco joined the Office of Federal Housing Enterprise Oversight, the predecessor agency to FHFA, in October 2006 as its Chief Operating Officer and Deputy Director. Finally, during the past 4 years, under the direction of Acting Director DeMarco, MBA and its members have enjoyed an open and collaborative relationship with the FHFA. For this, we are truly appreciative and hope that this precedent continues into the future. Ladies and gentlemen, please welcome FHFA Acting Director Ed DeMarco.
Morning, everyone. Thank you for inviting me to speak this morning. I'd like to start by congratulating the Mortgage Bankers Association on this 100th annual convention. That is quite a history, one that traces from a much different and more limited housing finance system to one that creates far greater access to credit, but that is recovering from a nationwide trauma in housing. The good news is that the recovery is taking hold. The opportunity for rebuilding our housing finance system to a stronger, more competitive, and more resilient market is before us. Yet challenges are all around us. Implementing an array of new mortgage rules, many developed in response to the recent market and regulatory failures, creates uncertainty as to cost and impact. And we have an opportunity to rebuild the secondary mortgage market, but the political and policy challenges of that legislation are numerous. Over the past 5 years in which Fannie Mae and Freddie Mac, or the enterprises as I will refer to them, have been in conservatorships, much has been accomplished. The nation's secondary mortgage market has continued to function. The enterprises' financial positions have stabilized. We've made significant progress resolving the pre-conservatorship book of business. The enterprises have played an important role in providing foreclosure prevention and refinancing options to borrowers. And through FHFA's strategic plan for the enterprise conservatorships, we've begun the process of building for a future housing finance system. However, even with those accomplishments, much remains to be done. The single-family mortgage market remains heavily supported by taxpayers. While there is progress on the legislative front, the timing of broader housing finance reform remains uncertain. In 2008, when the conservatorships were established, the immediate objective, or initial phase, was to stabilize the enterprise's operations and ensure that the secondary mortgage market continued to function. As markets stabilized, the second phase of the conservatorships focused on developing tools to assist troubled homeowners while reducing credit losses. The next phase is determining our responsibility to direct the conservatorships going forward. The law establishes the appointment of a conservator or receiver for the enterprises for the, quote, for the purpose of reorganizing, rehabilitating, or winding up the affairs of a regulated entity. In fact, we're doing all three of these things: reorganizing, rehabilitating, and winding up the affairs of Fannie Mae and Freddie Mac. This is exactly the path we set forth last year when we issued the strategic plan for conservatorships. More specifically, we set forth three strategic goals in that plan. The first is to build a new infrastructure for the secondary mortgage market. The second is gradually contract Fannie and Freddie's dominant presence in the marketplace while simplifying and shrinking their operations. And the third goal is maintain foreclosure prevention activities and credit availability for new and refinanced mortgages. We identified specific activities to achieve these goals in a conservator scorecard in 2012 and again in 2013, and much progress on those goals has been achieved. But as time moves on, the scale of the enterprise's operations in conservatorship cannot remain static. As of the end of last year, the amount of taxpayer capital to support their outstanding debt and mortgage-backed securities became fixed. Limiting risk exposure is vital to maintaining the adequacy of the remaining capital support through the Treasury support agreements. What seems clear is that Fannie Mae and Freddie Mac will cease to operate in their current corporate form at some future date, a date to be set by Congress. FHFA's conservatorship strategic plan is designed to prepare the companies and the market for that date while maintaining market stability and liquidity from now to then. The strategic plan aims to move forward with a transition to a post-conservatorship market, thereby making the final transition from the conservatorships as simple and as quick as possible. To more clearly define this process, FHFA will soon establish multi-year targets for Fannie and Freddie to further achieve these three strategic goals of building for the future, contracting the footprint, and maintaining market stability and liquidity. In this next phase of the conservatorships, We intend to build upon the accomplishments of the past 2 years while accelerating progress towards achieving each of the 3 strategic goals. I provided some thoughts on each line of the enterprise's business last week. Today, in my limited time, I'd like to focus on the single-family guarantee business. With an uncertain future and a general desire for private capital to re-enter the market, the overarching goal is that the enterprise's market presence should be reduced gradually over time. Now, we have 3 main tools to accomplish this objective. First, risk-sharing transactions are important for reducing the taxpayer's long-term risk exposure. In 2013, we set a target for each enterprise to achieve $30 billion in risk-sharing transactions using multiple types of structures. Both companies are on track to meet this target, and the transactions completed to date have been well received in the market. We are planning for the scope and depth of risk-sharing transactions to continue to expand. While these transactions and structures are very positive, they do rely on the underlying infrastructure of Fannie and Freddie. Going forward, I expect to see work done on other types of transactions, such as senior subordinated structures, for certain portions of the enterprise's mortgage guarantees. These alternative approaches will contribute to our efforts to build for the future by helping to develop a securitization infrastructure that is less reliant on the enterprise's traditional GSE securitization model. Second, guarantee fees are about double what they were prior to conservatorship. A key reason to increase guarantee fees is to bring the pricing for credit risk closer to what would be required by private sector participants. While that level is difficult to evaluate with precision, I believe we are getting closer to a level that would encourage more private sector participation, and we plan to continue pursuing gradual guarantee fee increases in the near future. Third, one of the most direct ways to increase private sector participation and reduce taxpayer exposure is through a reduction in the maximum size of loans that the enterprises guarantee. This summer, the President specifically endorsed a gradual reduction in maximum loan size. Since then, there has been much discussion about a near-term reduction in the loan limits. As you probably know, last week I made clear that I understood the potential timing issues associated with such a change, given the other regulatory changes that are scheduled to take place in the mortgage market. As a result, I said that FHFA will follow its practice of announcing the 2014 conforming loan limits in late November, at which time further information will be provided on potential reductions in the size of loans the enterprises will guarantee going forward. Now, to provide further clarity, FHFA will give market participants at least 6 months' notice of any change. Any reduction would be across the board, not just in some parts of the country. And consistent with our practice with increasing guarantee fees, any change would be measured and gradual so as not to disrupt markets. While these steps are important and necessary to carry out our conservatorship responsibilities, our efforts are also focused on building towards a future infrastructure to support the single-family mortgage market. FHFA is looking to reposition the enterprise's activities in ways that would support the various housing finance reform options pending in Congress. One of these efforts is the common securitization platform, with a focus on functions that are routinely repeated across the secondary mortgage market, such as issuing securities, providing disclosures, paying investors, and disseminating data. These are all functions where standardization could have clear benefits to market participants. We recently announced the formation of Common Securitization Solutions as an equally owned subsidiary of Fannie Mae and Freddie Mac. This new entity, which will have its own independent location and leadership, will manage the development of the platform and the associated data and legal infrastructure for future securitizations. Next year, a key objective for us will be to formalize a means for MBA members and other market participants to participate in the development process of the Common Securitization Platform. I'm committed to ensuring broad industry input into this effort. I am also committed to to an outcome that strengthens, not weakens, the ability of small and mid-sized lenders to access the secondary mortgage market. FHFA wants to see a competitive marketplace. Competition, and thus consumer opportunities, is enhanced when large lenders and small effectively compete in offering mortgages to families and compete in servicing those mortgages. But to get there, we must be willing to envision the mortgage market working differently than it has in the past. Another example of where change is needed is in the putback risk loan originators face when selling mortgages. The business practices of the past must be improved in this area. As purchasers and guarantors of mortgages, reps and warrants have long served as a key risk control mechanism for Fannie Mae and Freddie Mac to ensure that the loans sold to them meet the requirements set forth in their seller guides. Reps and warrants attracted less attention when times were good. The tremendous breakdown in loan origination quality during the boom period of the last decade led to unprecedented delinquencies, which has led to unprecedented loan reviews and putbacks. As conservator, FHFA believes that enforcement of long-standing contractual requirements was a necessary, albeit painful, process to protect taxpayers and assign losses where a contractual obligation exists. This experience demonstrated the need for improved quality control, including better use of technology to enhance the quality control on loan originations, and we've been working towards that end. Earlier this year, I committed that the enterprises would take 2 significant steps regarding reps and warrants. First, all rep and warrant claims to be made on pre-conservatorship loans need to be made by the end of this year. It is time for us to wrap up all open issues dealing with that period and move on. Fannie and Freddie are on track with regard to completing their repurchase requests. I'm pleased with the mutual cooperation of many counterparties to resolve these challenging business matters in a professional way, and I look forward to a speedy resolution of remaining claims in the coming months. Second, since the start of this year, for all new production, the rep and warrant model has been changed to rely upon a quality control review process taking place near the time of purchase rather than waiting until much later, such as when a mortgage becomes delinquent. The period for which the rep and warrant remains active, except for limited issues such as fraud, is now limited to 3 years for performing loans. For the future, we will continue to refine and improve upon this new rep and warrant framework. Important strides have been implemented this year, but there is still a learning process going on, and further developments and improvements should emerge over time. In particular, I anticipate improved data systems and technological developments to contribute to faster and more reliable loan reviews that can lead to further rep and warrant relief in the future. Still, this will take time. I hope that constructive dialogue between you as mortgage originators and Fannie Mae, Freddie Mac, and FHFA will lead to further enhancements that result in both improved mortgage origination systems and greater confidence that loans sold into the secondary market will not come back someday due to origination defects. Another area of progress in wrapping up the past is resolving securities law claims on private label mortgage-backed securities. These issues are somewhat analogous to the rep and warrant issue, and they too need to be resolved. FHFA has now settled 4 of the 18 outstanding lawsuits in this area, and we hope to build upon these cases to resolve the pending ones. An expeditious resolution of these remaining claims will allow the conservatorships and the companies involved to put past problems behind them and devote their energies and resources to improving the housing finance system for the future. As policymakers think about the future, I would note that our current housing finance system has its roots in the Great Depression. As a nation, we should look at this as an opportunity to build a new housing finance system, not for the next few years, but a restructuring that could last for decades. This effort should not be about considering just what Fannie Mae and Freddie Mac do in housing finance, but to consider the entire market, including the FHA and other government programs that support housing finance. Long-term, continued operation in a government-run conservatorship is not sustainable because each company lacks capital, cannot rebuild its capital base, and is operating on a remaining finite line of capital from taxpayers. Furthermore, a taxpayer-backed conservatorship provides a significant subsidy to the mortgage market that crowds out private capital and underprices risk in the market. It also places long-term decision-making in the hands of a government agency, decisions that should be made by private sector businesses based on reasonable returns on private capital. At some point, lawmakers will need to decide on the appropriateness and level of a government credit subsidy for housing. Such a decision should include whether a government-owned corporation should undertake some or all of the activities of Fannie and Freddie, or whether some or all of those functions should be repositioned in the private sector. In the meantime, FHFA will continue to carry out its mandate as conservator, accelerating its efforts to ease the transition to a post-conservatorship market ultimately defined by lawmakers. And the employees at Fannie Mae and Freddie Mac will continue to ensure their companies bring stability and liquidity to the market while they contribute directly to the building of that post-conservatorship market. Thanks very much, and best of luck with the rest of your conference.
Appreciate it. Thank you, Ed. We appreciate your time here today. And there we go. Our next guest this morning is Director of Consumer Financial Protection Bureau, Richard Cordray. He was appointed by President Obama in January of 2012 and confirmed by the Senate on July 16, 2013. Director Cordray previously led the Bureau's Enforcement Division. Prior to joining the Bureau, Director Cordray served on the front lines of consumer protection as Ohio's Attorney General. He recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help protect its consumers from fraudulent foreclosures and financial predators. Director Cordray also served as Ohio Treasurer and Franklin County Treasurer, two elected positions in which he led state and county banking, investment, debt, and financing activities. Earlier in his career, he was an adjunct professor at the Ohio State University College of Law, served as a state representative for the 33rd Ohio House District, was the first Solicitor General in Ohio's history, and was a sole practitioner and counsel to Kirkland & Ellis. Director Cordray has argued 7 cases before the United States Supreme Court, including by special appointment of both the Clinton and Bush Justice Departments. Ladies and gentlemen, please welcome CFPB Director Richard Cordray.
Well, I'm not Earth, Wind, and Fire, but thank you for asking me to come and speak to the convention. Those of you here today, as you know, represent the single biggest consumer financial market in our nation and, in fact, in the history of the world, with the mortgage market topping $10 trillion in value. You know firsthand how closely tied the mortgage market is to our overall economic stability and well-being. Just over 5 years ago, we saw this all too clearly as disruptions in the housing market precipitated the financial crisis that caused so much damage to the people of this country. And the current economic recovery is occurring in large part because the housing market is showing increasingly strong signs of recovery. The credit crunch, the financial collapse, and the ensuing deep recession will likely stand as the most significant financial events of our generation. They cost Americans trillions of dollars in household wealth. Many lost their jobs. Many lost their homes. Almost everyone saw their retirement savings shrivel. You had the graphic view from the front lines as history unfolded with the boom and bust in the housing market. Severe dysfunctions in the loans supporting mortgage-backed securities sent profound shocks reverberating throughout the financial system. The crumbling of the housing market destroyed jobs across every economic sector and in communities throughout the country. The dimensions of the failure were astounding. The American dream of home ownership was shaken to its foundations. People lost hope and confidence in the future. The housing collapse crippled our economy in ways not seen for generations. In the aftermath of the crisis, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, and as you well know, that law covers a broad range of topics to address the problems that led to the crisis and ensure they would not happen again. Among the steps taken in the law was the creation of the new Consumer Financial Protection Bureau. Part of our mission, therefore, is to ensure that the recent economic meltdown does not repeat itself. The developments that led to the financial crisis are inconsistent with the fair, transparent, and competitive markets that we are directed to promote. The aftermath of the crisis severely compromised consumers' access to credit, which we are also directed to promote. To accomplish these objectives, Congress gave us a number of tools to assure even-handed oversight of consumer financial markets and to prevent bad practices from taking root. When honest and innovative businesses can succeed on the merits, it begets the kind of fair competition that drives growth and progress. Appropriate market oversight and even-handed enforcement empower consumers to make sound financial decisions they can live with over the long term. We kept all of this in mind as best we could as we worked to develop and complete the mortgage rules we issued last January. As I'm sure you are well aware, two of our mortgage rules will be extremely important in addressing some of the most serious problems that had undermined the mortgage market. The ability to repay, or so-called qualified mortgage rule, is designed to end many irresponsible lending practices by making sure the simple proposition, consumers are getting mortgages they can actually afford to pay back. Our servicing rules contain provisions designed to ensure, among other objectives, a fairer and more effective process for troubled borrowers who face the potential loss of their homes. At the Consumer Bureau, we're committed to open, inclusive, transparent decision-making. Before we finalize our rules, we conduct research and solicit input from all stakeholders, consumers, advocates, industry members, and public officials. The best decisions will be those that are best informed. There's no question that our processes, including the many meetings we took and the broad input we received, led to better outcomes on the mortgage rules. Throughout the process, we heard overwhelmingly that the mortgage market in 2012 was vastly different from the mortgage market of 2006 and required much more focus on access to credit than would be true in more normal circumstances. The constrained mortgage lending so prevalent today was quite critical to our thinking about how to contour our mortgage rules, especially the ability to repay QM rule. By paying close attention to this input and by obtaining and analyzing more up-to-date data, we came to more balanced conclusions about how to define a so-called qualified mortgage and tailor its legal consequences. One further illustration of our approach is our treatment of smaller creditors under the rule. Through extensive discussions with community banks and credit unions and analysis of performance data for loans originated during the boom years, we came to recognize that most of the traditional lending practices should not be put in question by the ability to repay rule. Especially where smaller institutions make loans that they keep in their own portfolios, they have every incentive to pay close attention to the borrower's ability to repay the loan. They are more immediately subject to community norms, and their underwriting standards did not deteriorate in the heady days before the financial crisis. Indeed, they often lost market share to those engaged in the more irresponsible lending practices of that era. So the rules contain provisions that avoid a one-size-fits-all approach by extending specific protections to meet the special circumstances of smaller mortgage lenders. Qualified mortgages cover the vast majority of loans made in today's market, but they're by no means all of the mortgage market. This point is important and it should not be misunderstood. There are plenty of good loans made every year. For example, loans made to a borrower with considerable other assets or whose individual circumstances and repayment ability are carefully assessed that are non-QM because they do not meet the 43% debt-to-income ratio or are not eligible for purchase by the GSEs, but nonetheless are based on sound underwriting standards and routinely perform well over time. Lenders that have long upheld such standards have little to fear from the ability to repay rule. The strong performance of their loans over time demonstrates the care they have taken in underwriting to ensure that borrowers have the ability to repay. Nothing about that traditional lending model has changed, and they should continue to offer the same kinds of mortgages to borrowers whom they evaluate as posing reasonable credit risk, whether or not they meet the criteria to be classified as qualified mortgages. Last week, we took another step to address industry concerns about fair lending risks associated with offering only qualified mortgages. Together with the other banking agencies, we explained our joint viewpoint that we do not anticipate that a creditor's decision to offer only qualified mortgages would, absent other factors, elevate an institution's fair lending risk. Another issue that some consultants and lawyers have raised is whether the law and our rule will deliver the assured and predictable legal protections even for QM loans. We strongly believe that they will do so. There are two key points here: the size of the QM space and the effectiveness of the legal safe harbor. First, by expanding the definition of qualified mortgage for a period of years to include not only loans that satisfy the 43% debt-to-income test, but also loans that are eligible for purchase by the GSEs while they're in conservatorship, or eligible for guarantees or insurance from the FHA, the VA, or the Department of Agriculture, the QM space has been drawn quite broadly. Indeed, the small creditor provision expands the rule's coverage even more. And though no data is available to model the precise impact of the 3% threshold for points and fees mandated by the statute, that threshold is more than 3 times the average lender origination fees reported by Bankrate.com in its most recent annual survey. And our rules provide an even higher threshold for smaller loans. Based on the other elements of the QM definition, we estimate that more than 95% of the mortgage loans being made in the current market will be QMs, as Mark Zandi of Moody's Analytics recently confirmed. Some, such as CoreLogic, have put out much lower figures, but by their own admission, those figures were not intended to take account of the expanded definition of QM that will actually take effect in January, but instead were offered as projections of a more distant future when the temporary expansion expires in a period of some years. Indeed, CoreLogic acknowledges that as long as the temporary expansion remains in effect for GSE qualified loans, which may well be for several years, the impact of the regulations, this is a quote, will be minor. Second, our rule does apply the legal safe harbor to all prime QM loans, which affords effective protection against legal challenges for loans that satisfy the QM criteria. The key point here is that we left little room for legal challenges to whether a given mortgage is QM. We purposely drew bright and sharp lines to define the contours of a qualified mortgage, such as the 43% debt-to-income ratio, or eligibility for purchase by the GSEs while they remain in conservatorship, or portfolio loans made by small creditors as specifically defined. A large number of industry commenters asked for these bright lines, and we agreed that approach made sense. If those lines were not drawn as sharply as they have been, then much would have remained to be fought out in the courts for years and years before the definitions were made clear. We crafted the rule purposely to avoid that result, which is why critics are now forced to dream up hypothetical factual disputes about whether debts and incomes were correctly calculated in their efforts to criticize the rules or sow anxiety about them. The main provisions of our mortgage rules will take effect in January, and we have a team devoted to the regulatory implementation process. We're engaged in vigorous outreach and assistance to financial institutions. We view this as a joint enterprise, and we're interested in learning how we can make things go more smoothly and achieve better results. We believe that the Bureau's responsibility for the rules we promulgate does not end with simply finalizing a set of regulations. It's not good enough for us to take the view that once these new rules are published, our work is then done, and we can say to financial institutions that it's your problem now. If the whole point of our regulations is to protect consumers and promote fair, transparent, and competitive markets, then we should care, and we do care, about how well the rules are understood and implemented, how operational issues can be more easily addressed, and the amount of effort required. And we have shown that we do care deeply about these things. Our regulatory implementation project goes further than simply responding to industry inquiries, as we're doing many times every day. We've also taken more affirmative steps to help the industry understand our rules. We published plain language compliance guides that we will update as necessary. We launched a series of videos explaining our rules. We work closely with the other financial regulators to develop examination guidelines that reflect a common understanding of what the rules do and do not require, which were published well in advance of the effective date and are available for your perusal. Our goal with all of these efforts has been to provide as much advance notice as we could about what you should expect from the financial regulators as they engage in supervisory oversight on the mortgage rules. This work reflects close cooperation between the Consumer Bureau and the prudential regulators and our mutual desire to conduct examinations consistently. We distributed a readiness guide with a checklist of things to do before the rules take effect, like updating policies and procedures and providing staff training. We produced a joint agency statement addressing QM's and fair lending concerns, as I mentioned earlier. And we're consulting with consumer groups to determine how best to educate consumers with understandable information about how the new rules will affect them. As we become aware of critical operational or interpretive issues with our rules, we have addressed them. We made a commitment to respond to substantive interpretive questions that significantly affect implementation decisions in writing through amendments to the official interpretations and, if need be, to the rules themselves. We issued various amendments over the course of the year with a single aim in mind: to ensure the effectiveness of our rules by making it easier for industry to comply. By addressing and clarifying industry questions, we reduce the need for individual institutions to spend time reaching their own uncertain judgments on these matters. We understand that even though these beneficial amendments have responded to your request to remove obstacles to implementation, they have required you to make further adjustments. But we do not believe the Bureau's regulatory implementation project should slow the readiness process at any lender or servicer. Congress established a specific deadline for the effective date of the rules it directed us to write, and we set the effective date to reflect that deadline. The ability to repay rule in particular has been broadly expected since the passage of the Dodd-Frank Act in July of 2010, and actually requires little more than the sound underwriting practices that have become standard in the years since the crisis. And the general contours of the mortgage servicing rules track the problems that have been identified in this industry for more than 5 years, most of which were squarely addressed in the standards set by the National Mortgage Servicing Settlement adopted in 2011. We believe it's critical to move forward so that these rules can deliver the new protections intended for consumers and the certainty that the industry has been seeking. That will encourage consumers to take part in the mortgage market with improved confidence about how the market will function, even as responsible lenders will be enabled to conduct their mortgage businesses profitably. We understand this poses a challenge for industry, just as the writing of such a substantial set of mortgage rules by last January posed a significant challenge for our new agency. Had we failed to do so, many key statutory provisions that Congress had enacted in Title 14 of the Dodd-Frank Act would have taken effect in their own right, which everyone recognizes would have been much harder on industry and much worse for the mortgage market. We're all in this together, and so we appreciate the urgency and the resources that the mortgage industry is bringing to bear in preparation for the approaching effective dates. Let me also say that our oversight of the new mortgage rules in the early months will be sensitive to the progress made by those lenders and servicers who've been squarely focused on making good faith efforts to come into substantial compliance on time, a point that we've also been discussing with our fellow regulators. Our rulemaking process is designed to produce rules that deliver tangible value to consumers and make the financial markets work better. But as we've shown over the past year, we recognize that without effective implementation, this cannot happen. That is why we share the industry's focus on putting these rules in place successfully, and why we've rolled up our sleeves and worked alongside you to help get it done. When our rules can be understood consistently and applied effectively, that will produce better outcomes for consumers, for honest businesses, and for the economy as a whole. At the Consumer Bureau, we envision a consumer financial marketplace where reasonable and even-handed oversight promotes welfare-enhancing innovation, where consumer protections and business opportunities complement one another, and where financial institutions lead by modeling responsible, honest practices that benefit consumers and provide excellent customer service. We believe that such a marketplace will be beneficial to all those involved and will lead to long-term sustainable financial conditions that strengthen the future of this country. Thank you.
Every Monday at this time, it's our weekly Your Money segment. For this segment, we are going to be focusing on a program that offers a tax credit to low-income working families and singles. It's called the Earned Income Tax Credit. This segment, you should know, was prompted, in a sense, by a report that came from the Inspector General office in the Treasury Department, specifically looking at the program. To talk about the report and the findings, joining us on the phone is Michael McKenney. He's with the Treasury Inspector General for Tax Administration. He serves as the Deputy IG for Audit. Mr. McKenney, thanks for joining us.
Sure, thanks for having me. Appreciate it.
So just to give a little explanation, this report that came out that looked at the Earned Income Tax Credit, what was the intent of it?
Well, the executive order requires us to review the IRS's progress in reducing improper payments, and we do this report annually. The IRS reports to us, and within 120 days we issue a report, and the report really assesses their actions to help reduce it. The Earned Income Tax Credit is really the largest program it has where they make payments to taxpayers, and that's the program that we assess.
And specifically, it looked at tax credits that were put out in 2012. What was found out?
Well, one of the main provisions in the executive order is that the agency is required to set reduction targets as well as a plan to achieve those reduction targets. The Earned Income Tax Credit has a pretty high improper payments rate ranging between 21 to 25%, which equates to about $13 billion. But the IRS has not set any reduction targets or plans to achieve those reduction targets, and that's still a major concern.
So when you say improperly paid, these are payments that should have never went out in the first place?
Right.
And according to the report, the estimated payments of the Earned Income Tax Credit, about $62 billion. You say about 20 to 25% of that was improperly paid.
Right.
Talk a little bit about why this happens then.
Well, there's a number of issues that cause that, but primarily there's two main issues. One is that people misreport their income to either maximize the credit, or they report dependents that aren't qualifying dependents.
So
there's several problems that the Treasury recognizes as things that contribute to the improper payments, and a lot of it has to do with the complexity of the requirements, so there's confusion among eligible claimants. There's really a high turnover, so every year there's a lot of new people that haven't claimed EITC before. There's also, just fraud, and there's also tax return preparers that don't exercise due diligence on before they claim the credit.
So of those problems that you listed, how high is fraud on that list?
It's not. I'd say all of those factors factor equally into that. I don't think anyone has come to the conclusion that any of those factors are primary factors. They all factor in equally.
Mr. McKenney, it also says in the report this isn't the first time it's happened. This is a regular occurrence.
Right. Yeah, we've been required to assess this for at least 3 years now, and the IRS has not yet set those reduction targets. One of the things the IRS was hoping to do, and that is put in a regulatory schema for tax return preparers. Their view was that would help a lot in reducing this, but there was an injunction recently against them implementing that program, so that's been somewhat of a setback for them.
So in light of this recent report, has the IRS indicated that they are going to step up the process of making sure these payments don't go out?
Well, they're working with the Office of Management Budget to really identify alternatives to setting reduction targets. One of the concerns about setting reduction targets is the possible setting themselves up for failure in terms of having to examine a lot more returns, and they don't have the resources to examine a lot more returns than what they're examining.
Specifically, how did the IRS respond to your findings?
They agree with us. They're working with Treasury on setting up a methodology for alternative compliance methods, and they're also working with OMB to set up alternative measurements.
And Mr. McKinney, will there be a follow-up on whether they're meeting their responsibilities?
Yeah, we'll be reviewing this annually.
That's Michael McKinney. He's with the Treasury Inspector General's Office for Tax Administration. He is their Deputy Inspector General for Audit. Thank you for your time, sir.
Thank you, Pedro.
To continue on the conversation about these tax credits, we're joined at the table by William McBride. He's with the Tax Foundation. He's their chief economist. First, a couple of sentences about the Tax Foundation and what it is.
Sure. We are a research organization. We've been around for 75 years. We research tax policy, nonpartisan, independent, nonprofit, and we're a reliable source for analysis of tax policy at all levels of government.
So let's start, before we go into the details of the report that we just heard about, the Earned Income Tax Credit. Could you offer our viewers an explanation of what it is? Sure.
So it's one of the oldest, I believe it is the oldest refundable tax credit program. It goes back to 1975 under the Ford administration. And the idea is to a supplement to the working poor. So you first have to report some amount of income above zero, and some amount of income that's below some threshold that's somewhere around the poverty threshold. And so it's the thing that's happened to it over the years, over the administration since the 70s. It's been expanded and enlarged and made more generous in stages and made more complex. So it now is dependent on the number of children. So in 2009, it was the most recent expansion of it to a third child, benefits depending on a third child. And so it's both dependent on the income level and the number of children reported.
So talk a little bit about the sense that it is a tax credit, but it's for people who are already working. How does that work?
That's right. That was the design. It was meant to supplement incomes of the working poor. So that sounds fantastic. It does have the effect of bringing more people into the workforce that otherwise would not be. It's paying people to enter the workforce, in essence. And that was the design. That was what made both parties agree to it, and ever since, both parties have championed this tax credit program. The problem is that the way it was designed from the beginning and continues today, it phases out over some income range at about, depending on circumstances, somewhere around $30,000 in income. It starts phasing out. So whatever incentive it creates for people to enter the workforce, it takes it away in terms of the incentive to work additional hours or earn more money, get a raise, bring in an additional worker from the household. So the incentives are a wash or negative, depending on the productivity of the workforce in those two income ranges.
The IRS says that if you make $45,060 and you have 3 or 4 more qualifying children, you apply for this credit, or at least you can get it. That goes down as number of children goes in. So what happens if a person who falls under this doesn't pay enough in taxes? Do they get money back in return?
Absolutely. So there's the refundable aspect of it is actually the biggest part. So refundable means that it becomes a spending item at that point. It's actually booked by the federal government as a spending item. And so this is about 3/4 of the $60 billion a year spent on the Earned Income Tax Credit. About $45 billion or so is spending, meaning that it's spent on recipients who have no tax liability. So it is really much like spending at that point.
So if I make more in taxes, I get a credit. If I don't make enough in taxes, I get cash back.
That's correct.
And so when a person applies for this, you heard our previous guests on the phone saying that some of these folks don't know how to apply for it. Some put the wrong information. Some of it's accounting for fraud. Mm-hmm. Talk a little bit about the complexity, because he even referenced the complexity of this program as well.
Sure. Well, the problem is there's not enough awareness out there of the program, and the IRS has in recent years instituted various awareness programs. There's an Earned Income Tax Credit Awareness Day sometime in February, I think. And the problem is that it is structured in a complex way. So I would have difficulty explaining to you all of the nooks and crannies of this the phase-in range of income, and then there's a plateau, and then there's a phase-out range, and it's dependent on the number of children. The interaction of all that stuff means that even professionals have a difficult time predicting what the amount will be for these circumstances. Off the top of my head, anyway, I have difficulty. So recipients are at a total loss. They are then reliant on professional tax preparers, and this is where the unscrupulous tax preparer aspect comes in that the IG's report referenced. So you have a lot of taxpayers who are, this becomes a cottage industry, sort of recruiting taxpayers, tax filers, generating some income for them, sometimes fraudulently, to meet the eligibility requirements, and then they fill out all the paperwork and take care of the details. So anyway, it is too complex for most recipients. The vast majority end up using a tax preparer because they're not aware, they don't know how to do the paperwork, they're not sure how to meet the requirements, et cetera.
The Earned Income Tax Credit is our topic for this Your Money segment. You heard the Inspector General say about $13 billion or so improperly put out in 2012. We'll talk about that, talk about how other aspects of the program work with our guest here, William McBride. But if you want to give us a call and ask us questions about it, 202-585-3881 for Republicans, 202-585-3880 for Democrats, and 202-585-3882 for Independents. You can tweet us as well at C-SPAN WJ. Let's start with Lee in Norman, Oklahoma, Republican line. Lee, good morning. Go ahead. You're on with William McBride.
Hello, sir. Very nice to meet you. I have a question for you, or more of a comment. On the bottom of the AGI form, when you sign that, and especially when you sign your federal tax reform form or your state tax form, you are stating that you understand the laws and principles that are behind the form, the AGI limits. And when we're looking at this, and I've got it paused on my screen here, and I'm looking at the 45,000, and I'm a disabled veteran, and I'm retired, and I spent a long time overseas, but I also see, like for my mother, she's around a $7,000 a year waitress that does on her own home, that can't qualify. She doesn't have children, which is understood. But when we put laws out there and say, well, this right here is something that's going to help families at 45 or less, 13,000, we'll start at the bottom. But then we're not holding people accountable, and I see these, like you said, these fly-by-night tax preparers that are out here in the Statue of Liberty twirling signs on the roads. That is what bothers me when we come back to hold people accountable. I've been held accountable in the military for ensuring aircraft were flight-worthy. My name goes on it to ensure the pilot's safety. I don't understand how this is any different.
Okay, caller, thank you. Mr. McBride.
Okay, so, well, there's only so much you can expect from a tax filer. I mean, they have only so many hours in the day or a year to devote to filling out their tax return, and it's just gotten more and more complex. So there's been, I mean, we know all the stories about how complex the tax code has gotten, and we're seeing it every day getting more complex. There's on average been a change to the tax code every day for the last 10 years. So filers can't keep up with this stuff, and the accumulation is really mind-boggling. And it's not surprising that recipients are having a difficult time understanding this. They don't have the time to devote to it, so they rely on tax preparers. They're sometimes sought out by tax preparers, in this case, to meet these requirements. So it is the ultimate source of the problem is the complexity of the law. And I think we should really question whether the tax code is the right place to do something like this, rather than on the spending side, which is more straightforward.
Alana from Batesville, Arkansas, Independent line.
Yes. Can you hear me?
Yes, you're on. Go right ahead.
Hello. I'm a enrolled agent in private practice with over 27 years experience, and I agree. The EIC pub is over 54 pages long. Most individuals do not understand the complexity. As long as we have non-licensing and we have e-filing where an individual can go online and literally take something like TurboTax. I'm not saying it's TurboTax's problem, but like TurboTax, and juggle numbers to get what they want, and they don't understand that they're doing something wrong, they're going to continue to do this. We can upload documentation to prove evidence that children live with them, that they are their children, and you can solve a lot of this by having a licensed professional actually issue these proper tax returns. We cannot continue to let individuals who really do not understand this. We have no other agency that allows them to simply go up and fill out their own food stamp program, fill out any program that is part of a government assistance program at their own home, at their own computer.
Alana, you said it was the document's 54 pages long. Is there a way to make that simpler for the average consumer?
It really is not, because of the complexities of the law. The law itself has a lot of complexities to it. It is a perfect design to help a low-income family. It has a perfect design. It is just very abused. A professional has the ability to upload documents and prove that they are their children, that they live with them, and the professional understands how to actually apply the law properly.
Alana, thank you so much.
Well, I think that is one way to get at the problem. Simplifying the law and maintain it in the tax code. I think, again, though, it's difficult to do what we're trying to do here, keep track of people's income and the number of children, and pay them accordingly, and do that in a simple way. In addition to think of all the other things that the tax code is doing. Now it's doing health insurance. So I think the accumulation of all these functions we've built into the tax code over the years is the problem, and we need to fundamentally question that rather than trying to tweak it around the edges. I think the solution is moving programs like this into the spending category and have a spending agency responsible for it and have it go through the appropriations process in Congress and whatnot.
Take it out of the IRS, that's what you're saying?
Correct. Yes.
And how would that work under a spending agency? Will this become a grant to states or a block grant program of some type?
Sure. It could work either way. It is, I mean, as most welfare programs, they're done on the spending side, not on the tax side. So I think those are, there's more accountability there. There's less error, generally. I mean, the earned income tax credit is one of the highest error rates of any welfare program. There's Medicaid and Medicare, which are higher, but they are much bigger programs. I mean, I'm thinking in terms of the dollar amount. This $13 billion in improper payments from the earned income tax credit is approaching that of Medicare and Medicaid, which are much bigger programs. So I think we have to reassess and think about moving that over to the spending side.
Here's Joyce, Charleston, West Virginia, Democrats line.
Well, I mean, I can agree that the tax code, of course, it's just way too complicated. But you know what I'm really thinking about is, who cares? I mean, you've got $13 billion here. That's any of these families that have gotten money. I'm sure maybe they weren't eligible for some of it, but have you found any millionaires getting the money? I mean, they're poor people or very low-income people. And then I'm thinking also of, you know, this J.P. Morgan Chase thing, and of course I have been following the Wall Street thing ever since 2008. So when you talk about all of these people walking away with millions after they have crashed the economy, you know, and they still walk away with millions of dollars, then, you know, what difference does $13 billion make for some poor people? Maybe in West Virginia, you know, I don't know. I used to be a social worker, and I worked, I'm retired, of course, but I mean, you know, we're talking about poor people.
Okay, thank you.
Well, we're also talking about tax preparers here that the Inspector General's report labels as unscrupulous. So I think there's a good chance that some of those are not poor, those tax preparers, that some of them are probably getting quite rich from this cottage industry of targeting the earned income tax credit. You have other more criminal elements involved. I mean, there were stories over the last year of criminal gangs in Florida organizing around capturing people's refundable tax credits and tax returns. So, I mean, I think this is the criminal aspect is what is of concern here, not so much that it's some fraction of it is eventually getting to poor people. It's the criminal aspect that is the concern of this report.
It's important to note that the report that came out tracks the minimum. I mean, they couldn't even come up with a firm figure at the minimum that was spent in 2012 improperly, $11 billion. $13 billion, $13.6 billion is the maximum amount, and they trace it back over a period since 2003 when these type of payments come out, all coming in the double digits, with the total estimated amount on the maximum side, $132 billion in improper payments that have gone out.
Right, right. So, right, that demonstrates there's been really no improvement in regards to the IRS administering this program, monitoring it, and keeping track of who gets what. And I think we're just asked the IRS to do too much. I mean, the IRS has come back after these reports and said, basically, we can't do the ultimate monitoring technique, which is audits. We can't audit millions of people who are applying for this. Ultimately, there's about 27 million people who get the Earned Income Tax Credit. The IRS doesn't have the resources to do that, certainly now that they've been put in charge of health insurance. So I think, you know, we saw this past year with the IRS, the trouble they got into with trying to determine nonprofit versus for-profit status, et cetera. I think the IRS is just fundamentally ill-equipped to handle such programs. So again, it points to moving this over to the spending side, let a spending agency take care of it.
You probably answered James' question this morning because he asked, do agents ever go into homes to count dependents?
They do when they do audits, and that is the ultimate way to verify this information. But they can't do it for everybody. They can't do 27 million audits. So I think that's not a workable solution, and you know, we need to get serious about a more fundamental solution.
Sheila up next, Purcell, Oklahoma, Republican line.
Hi, I just want to say that lady said who cares about who gets the money. Well, I do as a taxpayer because it's coming from me. I worked in retail, and I would see some of the checks these people would get, $7,000, $5,000, and it wasn't just one. I mean, this is a small town, so this is going all over the United States. That is a bunch of money we are paying, that I'm paying for them. And one of the taxpayers said, well, they can work it on a computer at their home. Hey, I work. I could afford to get a computer, but I don't because it's going to cost me. But because they get it free, they were buying computers, toys. They weren't saving their money. They were spending it, and so they're still poor. So we really didn't help them. And also, I would like to ask you, how much do they have to work? Because I went over there to one of the booths that did taxpayers where they could do it in the store. Very little hours did they have to work in order to qualify for this unearned tax credit. And it really bothers me on the waste of taxpayers' money, and nobody seems to care. Thank you for taking my call. I appreciate it.
Well, I don't think there's any requirement as far as the minimum number of hours worked. You have to demonstrate that you have some amount of income above zero, I believe is the only requirement. It has to be below a threshold depending on the number of children you have. So the whole idea is to target low-income households to supplement their income, and I don't believe there is any requirement about hours.
An explanation that was given is that, as the figure shows, and it shows it up there, workers receive a credit beginning with the first dollar earned income. The amount of the credit rises with the earned income until it reaches a maximum level, and then it begins to phase out at higher income levels. The EITC is, quote, refundable, which means that if it exceeds a low-wage worker's income tax liability, the IRS will refund the balance.
Yes, correct. So that is, again, the refundable portion is about 3/4 of the money, something like $45 billion a year. And again, that is really much like spending. It is in excess of any tax liability. So first, you get a refund of any taxes you've paid down to zero, and then if you have an additional tax credit, it is paid out from the IRS much like spending.
Can a person receive this credit and receive other assistance as well?
Absolutely. There's, as far as I know, there is no mutually exclusive part of this law. So I think that there are a number of welfare programs on the spending side. There are other programs on the tax side that could be taken along with this, particularly in relation to children. The child tax credit is another refundable tax credit. It's the second biggest refundable tax credit. It is just about as big as the earned income tax credit. The Treasury Inspector General's office has reported on that as well, the problems with that. It is also, much like the earned income tax credit, been expanded in recent years, most recently in 2009. So it has many of the same problems, but it is overlapping in income over low-income range and then also into middle and upper income. It actually goes up to, you can get it up to about $100,000 in income. So, and then there are other education-related refundable tax credits you can get over an income range. They're all structured very similarly. They have this phase-in range, and then they have a plateau, and then they phase out, meaning you get more and more subsidy as you work more and more, and then there's sort of a constant level of subsidy over some income range, and then there's those subsidies phase out, and that phase-out range is where you get the disincentive to work additional hours. And so there is really no effect on the economy. It's a wash, except for the fact that those over that higher income range, those tend to be higher more productive workers. They earn more by definition. So that is actually, on balance, it means it's a negative for the economy.
Matt from New Hampshire, Independent Line. Hi.
Yes, hello. This is really interesting. I've been doing a lot of research on fraud and abuse, and I understand the problems with fraud on the earned income tax credit, child care credit, school credit. I understand that. As a percentage, how does that relate to all tax expenditures? Because on the corporate side of things, I'm seeing numbers that are pretty staggering as far as what the government pays out for corporate tax expenditures as compared to what's paid out to private individual tax expenditures. And I'm using the word tax expenditures as far as the ECIC, the school credit, and tax breaks or tax expenditures that the corporate side gets, because I keep hearing it on a personal side, but is this the big part of this fraud? Or I recently discovered a report regarding farm subsidies and quite a bit of money. I don't remember, it was 17 million or 17 billion overpaid in a single year. How does, percentage-wise, how does the private side of the tax code equate to the commercial side as far as this type of abuse and fraud or misrepresentation of collection of these expenditures?
Thanks, caller.
Okay. Well, that's an excellent question. First of all, we can talk about the magnitude of the corporate side versus the individual side of tax expenditures. So about 90% of these tax expenditures that Treasury and the Joint Committee on Tax keeps track of, about 90% in dollar terms falls on the individual side. About 10% falls on the corporate side. So it's mostly on the individual side. We can look at then the growth of these tax expenditures over the recent years or last couple of decades. Since the last time we had a major tax reform that supposedly cleaned up a lot of these tax expenditures and got rid of a lot of deductions, et cetera, was 1986. So 1986, since then, virtually all of the growth in tax expenditures in dollar terms has been on the individual side. And it's been precisely in these programs like the Earned Income Tax Credit, the Child Credit, that are aimed at social welfare. That, in my opinion, should really be on the spending side for these problems of fraud. And the way they're structured, the thing we haven't mentioned here is that these are tax refunds. They come once a year. That's a major downside to trying to use them as a way to secure someone's income over the year. You get a giant tax refund, in the case of the Earned Income Tax Credit, as much as almost $6,000 just for that tax credit alone in the spring with your tax return, and then what do you do the rest of the year? So there's that problem of a giant windfall in the spring, which that is precisely what attracts the fraud. This is what the Inspector General has mentioned. It's that giant pot of money in the spring that is attracting a lot of criminal elements. And you could, if you did on the spending side, you could spread it out over the year, and which would reduce the fraud in itself and also provide more of a security of income, which is the purpose of the law.
Did you say that a person could receive up to $6,000?
Yes, correct. On the Earned Income Tax Credit. It's almost $6,000 in 2012, and it goes up every year. So 2013, it may be about $6,000.
Depending on how much you make and how many children you have, that kind of thing.
Yes, correct.
A viewer asked, what happens when the IRS overpays repeatedly? Then it's discovered that, the government go after overpayments? That's what she finishes up saying.
Yes, to some degree. They are limited by their resources. Their budget, the IRS, is and their budget has been relatively flat in recent years. The number of employees there has been relatively flat. Meanwhile, as I mentioned, there's been a change to the tax code every day on average. So the IRS is simply swamped with the complexity of the tax law and the poorly structured tax law that's creating these opportunities for fraud that the IRS is ill-equipped to monitor or enforce.
Here's Alan, San Antonio, Texas, Democrats line.
Yes, I work for something called the Volunteer Income Tax Assistance Program, which is a free tax preparer program, and it's all over the country. And since I live in a poor city of San Antonio, Texas, the majority of the work that I do there involves the Earned Income Tax Credit. Now, we go through an extensive training program that we spend at least 2 or 3 days teaching how to calculate the Earned Income Tax Credit. And I would say the majority of the ones that I do as a volunteer involves the Earned Income Tax Credit. And when I see the people's faces light up, these are people that are making like $20,000 a year with 3 children. And all right, they'll get $8,000 Earned Income Tax Credit, but that is what supports these people. And I think it's a great help to people. It just needs to work better, and the people have to be able to get it. An income tax preparer will charge $1,000 to add on the cost of that. So and I think the public needs to be made aware that all over the country there's this volunteer tax credit program, volunteer tax assistance program, where you don't pay a fee.
So when they come to you, they don't even know they can qualify it, or is that typically the case?
The thing is, most of the people that come have had it before, and they know, but they don't know how. They wouldn't know how to do it themselves. But we determine that. In other words, we see all their information, all their children and their credit, and the software that and this is run by the IRS, by the way. So the software that we use would actually prompt the preparer to calculate this Earned Income Tax Credit, and then the software decides how much and whether the person is eligible or not.
Alan, what do you think about I don't know if you've been long enough, about these improper payments that we were talking about and the amounts that go out from your perspective?
Well, from our perspective, from the volunteer group that we work with, which has some volunteer people and some paid professional people in there, it doesn't look to me like we make very many mistakes at this. In other words, now the only fraud that could be would be that do these children, after all, you're asking the people voluntarily to say, do these children live with you? And a great many of these earned income people are single parents, and they have 3 or 4 or 5 children. And the question, the children have to live with the parent. Well, sometimes they live with the divorced parent or the other parent or whatever. And we have to take their word for that.
Alan, thank you for the insight. Mr. McBride.
Well, that is it's important to know. And the Inspector General's report was not explicit about exactly the techniques used to sort of fake income or fake the number of children, and where the problem lies, if it's on the tax preparer side or if it's on the recipient side. It's probably some mixture. That's what it sounds like to me. And I think, fundamentally we have a poorly structured law here, and it does accomplish these wonderful things that have been mentioned. It does supplement income to a great degree. This is up to almost $6,000 in supplementary income for low-income households. And this is a big deal, and this brings a lot of, millions out of poverty, perhaps. But it could be done better on the spending side. It could be done more straightforwardly. It could be done with better monitoring by a spending agency, with better oversight by Congress. So I think this is something that we should consider rather than trying to tweak this law and add resources to the IRS to try to audit more people. I think that's a bad way to go. Bill Badley, Twitter says, he says, I understand illegal immigrants are filing for these tax credits. Is it illegal to do so? That was actually resolved in recent years to some degree. They now require a Social Security number, which is, of course, not entirely fail-safe, but that can be faked as well. But they solved a lot of the problem by going to that as opposed to a taxpayer identification number, which was all that was required up until just a few years ago. And in one of the reports by the Inspector General, they said that a large percentage of the improper payments were going to folks using these taxpayer identification numbers rather than Social Security numbers, indicating that they were going to illegal immigrants, probably. Here is George, Longmont, Colorado, Republican line.
Good morning.
Good morning, George. You're on. Go ahead.
Yes, I have a question. Earned income, is that included Social Security, or does Social Security include earned income?
Well, that's a good question. There is the Social Security income, I do not believe does not factor into the income requirements for this law, but I'm not sure. That's a good question.
Is the credit a congressional interest in the sense that people are trying to do things to change it or modify it in that case?
Well, it's only gone in one direction, really. It's gone in the direction of making it more generous, making it more attractive to these fraudsters, because it sounds so good, basically. Both parties have piled on. Every administration since the Ford administration has expanded this law in some way.